Hi, Lee Phillips here. I want to talk for 2 seconds about one of the three what I consider major tax techniques. One is shifting the income, making somebody else pay the tax. Two is postponing the tax, making it so that I don't pay the tax today, I pay the tax down the road. And Washington's good at kicking the can down the road. You might as well get good at it too. Those are other YouTube videos. This one I want to talk about changing the nature of the tax, the third technique. What's changing the nature of the tax? Well, let me give you a good example. If I hold an investment for a short period of time and sell the investment, I pay a higher tax than if I hold the investment for a long time and then I sell the investment. The nature of the tax has been changed from short-term capital gains or ordinary gains to long-term capital gains. There are a lot of other things that you can do to change the nature of the tax. We basically have two tax forms. We have what we call earned income, and then we have what we call unearned income or passive income. On all of the earned income, you have to pay the Social Security and the FICA and the FUTA and the self-employment and all of that sort of garbage. It amounts to 16, 18, 20% in some cases. On the unearned income, which is the rents, the dividends, the interest, that sort of stuff, you don't have to pay what I call the social taxes, the Social Security, FICA, FUTA, all that garbage. There's no tax like that on unearned or passive income. So if I can change the nature of my income from earned income to passive income, I save 15, 16, 20% right off the top. That's not a bad deal. That's a pretty good tax savings, guys. One of the major ways that people do that, if I'm in a company, I work for myself. I'm a lawyer, I'm a doctor, I have my little construction company, I make widgets, I sell stuff on eBay, I don't care what it is. If I sell stuff, sell goods or services, that's earned income. If, however, I can change it into passive income, then that's a pretty big deal. I save the taxes on it. So how do we do that? Well, if I have my earned income and I set up a company that can be an LLC or corporation taxed under subchapter S of the IRS code. What that says is money that's earned, and that's earned income, in this company has to go to pay me a wage. I have to take a reasonable wage. What's a reasonable wage? Well, go look out on the internet and see what the task that you do would be valued at in the job service sites. That's a reasonable income. Anything above that, I can take as a distribution, a dividend. It's not called a dividend, it's distribution out of an S corporation. And that comes out to me as passive income. I don't have to pay the extra 15, 20%, whatever it is, on the social taxes, on that piece that I take out as a distribution. That's a big deal, and I have saved little business owners tens of thousands of dollars because they were set up as a C corporation or they were set up as a partnership or a sole proprietorship. And on the sole proprietorship of the partnership, the only way you get income is earned income. If I set it up under the S corporation taxation structure, now remember that could be an LLC or a corporation taxed under subchapter S of the IRS code, then I take the reasonable wage and I take the rest out as the distribution. Big deal, guys. Another way that I can change the nature of the tax is I can set it up so that a lot of my income from my company goes to pay the rental on the building. I have a second company that owns the building. My operating company then takes the money I make from selling my goods or services, and we have to have a place to stay, so we pay the rent to the second company. First company gets a deduction that lowers the amount of money that I'm going to take as my earned income, and I move it over to the second company as passive income. Now, there are some rules that make it so that I can't just move all of my income into passive income. I can't convert it all, and you have to follow some rules. But basically, I have now taken earned income in the company and moved it over into a second company. Particularly works well, no questions asked, if the second company is owned by somebody other than me. In a non-community property state, and we've got videos on community property and common law, but in a non-community property state, my wife could own the second company, and that makes it cleaner in many respects. Or I can give each one of my kids a little piece of the second company. I'm doing this not only to be able to convert income into passive income, earned income into passive income, I'm doing it for asset protection purposes, which is a big deal. And we've got lots of YouTube videos on asset protection. If I get sued in the operating company because I screwed up somehow, then they're not going to be able to take the building away from me. The operating company didn't own the building, a second company owned the building, particularly if it's an LLC. And that's a whole other story, guys. But this concept of changing the nature of income is a big deal when it comes to taxing and how much money I actually put in my pocket. And the goal is to put money in your pocket. In fact, we've got a set out called the Advanced Tax Tactics. 10 things that everybody should be able to do. And I want to be able to lower your taxes by 50%. If you do those 10 things, now everybody's not going to do all 10, but if you take those things, you put them into effect, even just one or two of them, you're going to lower your taxes, and we're talking a chunk of taxes. Because the IRS is your major impediment to financial success. This is Lee Phillips talking on how to change the nature of the tax.